Welcome to our next video in Insights into IFRS 17, the new insurance standard. I'm Gail Tucker, PwC's Accounting Technical Leader for Insurance. I'm also a member of the ISB's Transition Resource Group, and for many years I've sat on the IFRS Insurance Accounting Working Group. I'm delighted today to be joined by Chris Hancorn. Chris is an actuarial partner in our Hong Kong practice where he's the IFRS 17 leader, and he also sits on the Hong Kong TRG. Welcome, Chris.
Good to be here.
So in this video, we want to cover the topic of revenue accounting for insurance. And this is an area that I think many insurers are going to find quite difficult under IFRS 17, particularly life insurers, because it's very different from what we do today. We talked about one aspect of that, the amortization of the contractual service margin at the TRG meeting in May. But before we get into that, maybe Chris, you can just explain to us a bit about what does the standard require?
Thanks, Gail. Well, under IFRS 17, insurance revenue depicts the provision of services from a group of insurance contracts at the amount that reflects the consideration that the entity expects to receive in exchange for those services provided. So over time, the revenue figure will be the amount of premiums paid to the entity in return for the services, adjusted for the financing effect and excluding any investment components. So it's not premiums themselves that are shown on the income statement, but rather the element of premiums that represent expected insurance services being provided. And in particular, this means the exclusion of investment components. And for many insurers, this will be a change in current practice because many insurers include all considerations received, including investment components in their current premium figure. So as a reflection of insurance services provided, insurance revenue includes the following three key components of insurance services: expected insurance service expenses, the release of the risk adjustment for non-financial risk, and the CSM release to profit in the period. Insurance revenue also includes amounts related to insurance acquisition cash flows, as these are covered by part of the premiums as well. So another way to think about insurance services part of the insurance revenue is it's the change in the liability for remaining coverage in respect of the insurance services provided in the period. On the other hand, insurance revenue will exclude amounts that impact the changes in the liability for remaining coverage in the period, but do not depict the provision of insurance services in the period. For example, actual cash flows from premiums received in the period, or any changes related to investment components.
The way I think about it actually is that as the liability for remaining coverage reduces as you provide services, you recognise that as revenue. And if we think about it, that's consistent with what we would do under IFRS 15 in other sectors for revenue recognition. So now let's have a little bit of a look at that contractual service margin portion. So if we start off with insurance contracts that don't have any investment service, what does the standard tell us about that?
Well, Gail, IFRS 17 requires an entity to recognise the CSM for a group of insurance contracts based on the services provided. And in determining the services provided, the entity needs to identify the coverage units in the group. That's the quantity of coverage provided by the contracts in the group. Now, in determining coverage units, an insurer needs to consider the quantity of benefits provided under each contract and also the expected coverage duration. The CSM is then released based on the coverage units related to the current period and the expected coverage related to the remaining expected coverage duration. So for example, if we determine that there are 100 coverage units at the beginning of a period, and at the end of the period there are 90 coverage units remaining in respect of future periods, then we release 10 coverage units in this period.
And this is the very aspect that we had a long discussion about at both the February and the May TRG meetings. So if we reflect on that, after the February meeting, the ISB staff did quite a bit of outreach and looked at individual products, trying to understand what do we really mean by quantity of benefits. So if I reflect on the May discussion, I think where all the TRG members got to is when we're thinking about this, we can look at the likelihood of an insured event occurring only to the extent that it will affect the duration or length of the contract. We don't take into account the likelihood or probability of the claim occurring when we're thinking about the amount. And I think that's quite important. And if I bring that to life, for example, death. If you die, you don't carry on having an insurance contract because you're dead, and so you would build that into the contract.
So Gail, when you discuss this on the TRG, for contracts that do not include investment components, And we'll come on to the topic of contracts with investment components in a moment. I sort of got the understanding that you concluded on the key principles for contracts without investment related services, but the judgments and estimates are required to achieve the principle of reflecting the services provided in each period. So selecting coverage units will definitely not be an accounting policy choice. It's an estimate that's selected to achieve the best objective of depicting the services provided, and therefore needs to be applied consistently unless the services change.
I think that's right. It's definitely not an accounting policy choice, and I think insurers are going to have to look at the individual products and think through what are the services provided. And there was actually quite a detailed list of examples in the staff paper, which I think is helpful for people to work through. And interestingly, in some circumstances, it might be the maximum contractual amount. In other circumstances, it might be straight line, just taking into account the run-off period of the contracts in that group. In other circumstances, it could be premium, but again, people would need to think whether premium represents the service provided. I think the one thing that was quite helpful is in any particular period, it's the service provided in that period, and that can change over the contract period as well.
So if we think about an example in practice, say a credit life loan insurance product where the product pays a death benefit equal to the principal and interest outstanding on a loan at the time of death. Now the balance of the loan will decline because contractually scheduled payments cannot increase. In this case, the expected coverage duration will reflect the expected deaths and lapses, and the coverage units could be the contractual balance outstanding, because it represents the amount the entity expects to pay in the event of a valid claim.
Yeah, and I think that's a really good example, because the one thing the TRG discussion did do is highlight that example for me, that it could go down over that period. And I think that's a really important thing. And the way I think about the principle, it's that in any particular period, what is the amount that the policyholder could contractually claim? And in your example of that credit term life, it is reducing as the principal of the underlying loan is reducing. But unfortunately, that was the easy bit, the insurance contracts without investment components. So what about the ones that do have investment components?
Well, the ISB proposed that for contracts applying the variable fee approach, in determining the quantity of benefits, the entity would include consideration of the pattern of services for both insurance and investment-related services. This is because the contracts applying the VFA provide investment services, and changes in the entity's share of returns from the underlying investments are regarded as changes in the entity's compensation for the contract. However, a narrow amendment to the standard was suggested by the ISB staff to the definition of coverage period to cover not only the period during which the entity provides coverage for insured events, but also the investment service period. And that's to be consistent with the view of the quantity of both insurance and investment services being reflected in the CSM.
That's right, and this was actually quite a difficult bit of the discussion at the most recent TRG meeting. So you're absolutely right, the staff are proposing a change to make it clear that for the contracts that are in the VFA model, that period or service is reflecting both the insurance risk and the service risk. All of us as TRG members challenged the concern that there are other life insurance contracts, and I think of things like the universal lifestyle contracts, where some of those will not qualify for the VFA model, but nevertheless they clearly involve investment services. If we follow the standards as it's written, what would happen is within those contracts, when you're looking at the contractual service margin on day one, quite a large proportion of that unearned profit can actually be the spread that's accumulating over the expected coverage period. So just the difference between what I'm going to credit to you as on your universal life contract and what I expect to earn on the contracts that back that. And it seems very odd that you would amortize that profit just over the insurance period. You know, I could take an extreme example of I might have a 2-year insurance death risk period within a 10-year universal life savings period. Do I earn all that spread on the savings component in the first 2 years? So that was something that the TRG members questioned whether that was right and whether the standard would need an amendment from that as well. The ISB staff fed that back to the board members at the recent board meeting, but we will need to wait and see whether that changes or not. So thank you, Chris. That's quite a lot we've covered today. Hopefully that's a starter for 10 for how you account for revenue. I do hope you found this video useful, and please do watch some of our future ones. Thank you.